Welcome. Let us continue preparing you to pass the Securities Industry Essentials (SIE) exam. This segment will examine different packaged products such as mutual funds, unit investment trusts, UITs, and closed-end funds. Although each of these investments has different characteristics, they share one common element. Each provides investors with an efficient way to quickly buy or sell a group of underlying stocks and/or bonds. SIE candidates should place special emphasis on the mechanics of buying and selling these products, as well as on the appropriate client disclosures. Types of investment companies. An investment company pools funds from numerous investors and purchases securities that are held in a portfolio for the benefit of those investors. The method by which investment companies are organized and operated is governed by the Investment Company Act of 1940. The Act of 1940 identifies three different types of investment companies: face amount certificate companies, unit investment trusts, UITs, and management companies. The Act further divides management companies into open-end and closed-end companies. Open-end management companies are more commonly referred to as mutual funds. Open-end management companies, mutual funds. Open-end management companies are by far the most popular type of investment company. The basic idea is that, for a cost, a mutual fund provides a means for investors with similar goals, for example, long-term growth, to pool their money and invest in a portfolio of securities. Just like other companies, this investment pool elects a board of directors, BOD. A mutual fund's BOD will hire an expert, that is, an investment advisor, to perform the security selection and trading functions. Some advantages offered by mutual funds include the following: diversification. Essentially, the diversification in a mutual fund is exemplified by the adage, "Don't put all your eggs in one basket." Diversification allows investors to reduce their risk by spreading their money among many different investments. Diversified versus non-diversified. A management company may be either diversified or non-diversified. In order to qualify as a diversified company, the portfolio must be invested in the following specific manner. At least 75% of the assets must be invested in a diversified manner with A. No more than 5% of the invested assets may be in any one company. B. No more than 10% of the voting stock of any one company may be owned. A diversified company must meet these standards at the time of initial investment. Subsequent market fluctuations or consolidations will not nullify the company's status as diversified. A non-diversified investment company usually invests in a specific asset category or industry and a few securities within each category or industry. The risk with non-diversification is that bad news from just one or two companies in a particular industry can hurt the prices of all stocks in that industry. Professional management. Most retail investors don't have the time or expertise to manage their own investments adequately and cannot afford to hire their own professional manager. By investing in mutual funds, investors receive professional management services for much less than they would have to pay individually. These money managers must be registered as investment advisors under the Investment Advisors Act of 1940. Note that an investment advisor, IA, is the management company, while investment advisor representatives, IRs, are the individuals who work for the IA. Liquidity. Liquidity is defined as the ability to sell an asset at a reasonable price within a short period. Mutual funds are extremely liquid investments. However, unlike standard stocks, mutual fund shares are not traded throughout the day. Instead, mutual fund shares are issued by, and subsequently redeemed back to, the fund itself. Exchanges at net asset value. Another benefit of investing in mutual funds is that shareholders may exchange the shares they own in one fund for shares of another fund at the net asset value, the fundamental value of the shares, as long as both funds are in the same family or brand name. If the exchange is made within the same fund family, an additional sales charge will not apply. Convenience. A person who wants to invest monthly may arrange to have the funds automatically deducted from their checking account. Investors are also able to have income dividends and capital gains reinvested automatically. Record keeping. Mutual funds provide a number of services that make investing easy. The fund takes care of most of the record keeping and ensures that shareholders receive regular reports that show their purchases, redemptions, and end-of-the-year tax summaries, like Form 1099 DIV. Additionally, mutual funds must send detailed financial reports to their shareholders at least twice per year. These semi-annual and annual reports provide shareholders with the most current information about the fund's finances and holdings as of a particular date. SEC registration. The Investment Company Act of 1940 requires every investment company that has more than 100 shareholders to register with the Securities and Exchange Commission, or SEC. Also, a fund must have a minimum net worth of $100,000 in order to offer its shares to the public. Prospectus delivery requirement. Any offer to sell a fund's shares must either be preceded by or accompanied by the current prospectus, since mutual fund purchases are primary issuances. The delivery may be made in physical or electronic form. Dealers must have systems in place to ensure that clients receive this document before any purchase orders are processed. Additionally, registered representatives are not permitted to alter, mark, or highlight a prospectus in any way. Mutual fund terminology. Since mutual fund disclosure documents use specialized language, a list of substitute terms is provided as follows. The sales charge is also referred to as the sales load. The net asset value, or NAV, is also referred to as the bid or redemption price. The public offering price, or POP, is also referred to as the net asset value plus the sales charge, if any. Additional disclosure. The Statement of Additional Information, or SAI. The Statement of Additional Information provides more detailed information than the prospectus about a fund and its investment policies and risks. Unlike the prospectus, the SAI is not required to be given to any person who simply expresses an interest in purchasing the fund's shares. However, the fund is required to provide a copy of the SAI to any person who requests it. The organization of a mutual fund. Although most mutual funds are organized as corporations, some are established as trusts. In many ways, the structure of a mutual fund resembles that of a regular corporation. A fund has a board of directors responsible for administering the fund for the benefit of the shareholders. The fund's shareholders are the individuals who invest their money in the fund. To avoid overwhelming you with lengthy videos, we'll keep it short and easy to digest. Join us for a follow-up video continuation where we will continue the discussion of mutual funds and end with closed-end funds and UITs, or unit investment trusts. As always, please like this video so others can benefit too. If you are a new viewer, we invite you to join our family with a free subscription.